Are you a first-time home buyer with limited funds wondering which loan program is right for you? Well, in today's episode, we're actually going to dive into that question. We're going to talk about all of the different types of loan programs and how they might fit into your life as a first-time home buyer. So, Josh, we get a lot of questions on the podcast asking about which program is right for me. And we've done different episodes where we've compared, say, FHA to conventional and just different things, but we've never taken it, full scope, bird's eye view of all the loan programs. And that's what we want to do today.
Absolutely. All of those minimum down programs that are often used by first-time buyers. Mm-hmm. Some of them have different requirements. So we're going to go through what's the down payment? What's the eligibility? How do they vary by interest rate? What does mortgage insurance look like? What type of properties can you buy with each of these programs? So the questions that we get week after week after week on the live show, people saying, what about this program? I want to buy this property with this program. Is this the right one for me? Hopefully in the next 30 to 40 minutes, you're going to get a broad overview of all of those programs. And remember, we can't go into detail on all of these. Every one of these programs has 30, 40 pages of matrices that kind of go through everything. But we're going to cover the broad stuff to help you determine, is that likely the right one for me, to kind of set the stage for your conversation with a lender when you're ready to make that move.
And don't take the information today and just run with it and say, hey, I heard them talk about FHA. That's my loan program. That's for me. We've talked about it before. Go into the process with an open mind. When talking to a lender, if you have, or if multiple options are available to you, talk to them about it. Just compare, apples to apples, if you will, when it comes to down payment, when it comes to credit score, how much money am I going to have to bring in? What's my monthly payment? All of those different factors so that you can ultimately make the right decision. This is just a bird's eye view, some guidelines, so to speak, to just kind of set you in the right direction. So Josh, let's kind of start the conversation by talking about what loan programs we're going to be talking about. And what are the required down payments for those programs? Because that kind of sets the precedent in a lot of ways.
Perfect. So the big one that everyone knows for first-time buyers, even though it's not limited to first-time buyers, is FHA. FHA requires 3.5% down. Conventional loans, Fannie Mae and Freddie Mac, there's a myth out there. A lot of people think you have to put 20% down. I had someone tell me this week, hey, I thought it was 5 or 10% down I had to put for that program. You can do a conventional loan if you are a first-time buyer with 3% down. There's also sort of a subset of this for people who are at or below 80% of their area median income. Freddie Mac calls theirs Home Possible. Fannie Mae calls theirs Home Ready. And there's some significant advantages that you'll see when we get down to rates and mortgage insurance. You get reduced interest rate, reduced mortgage insurance with both of those options. Then we have two sort of specialty or unique programs that require either the property or you to be eligible to use them. And that is USDA, which is a zero down program, and VA, which is also a zero down program. So we have anywhere from 0 to 3.5% down with the programs that we're going to be going through today.
No, that's good. And you kind of went over the eligibility a little bit, but none, well, I can't say none. Home Ready, Home Possible, I believe, are more geared first-time home buyer type programs. I think there's some sort of requirement there. You can elaborate on that. But in general, you can use these programs multiple times throughout your home buying career, so to speak. So why don't we just talk a little bit about the eligibility piece of this?
So with FHA, a little bit of a misconception that you have to be a first-time buyer. It's not limited to first-time home buyer. Anyone can use the program. There are a couple of limitations. You can't have 2 FHA loans, with a couple of exceptions. If you get moved for a job, if you have 3, 4, 5 kids and outgrow your property, there are some exceptions. But for the most part, you cannot have 2 FHA loans. And then FHA also has the 100-mile rule. So if you own a home and you want to buy another home 5 minutes down the road with FHA financing, you will not be able to use any income from the departing residence. So you would have to be able to keep both properties and qualify for both payments. If you're selling the departing residence, no big deal. You can absolutely use FHA, but if you want to keep it, it can be a problem. So when we look at that conventional 97, it does require you to be a first-time home buyer. So if you're not Home Ready or Home Possible eligible, you have to be a first-time home buyer to use either Fannie Mae or Freddie Mac's 97% option there.
And what is a first-time home buyer, Josh? Like, what is the qualification? Because this is important.
Perfect. It doesn't mean that you have never owned a home. It means that in the last 3 years, you have not taken the mortgage interest deduction on your tax returns. 99% of programs have a first-time buyer requirement. That is the exact definition of how they measure it. And you can often be requested to provide 3 years of tax returns, even if the tax returns aren't required for underwriting, just there to prove that you have not taken that mortgage interest deduction in the last 3 years.
Good stuff.
So,
and so that leads us into
that home possible and home
Yep.
ready actually gives you some expanded. You don't have to be a first time home buyer. So if you're at 80% or less of the area median, you can own up to one other property with those. So it opens up some additional eligibility and still being able to do 3% down. And we're going to go through those numbers, but you'll see some parts of the country, not even possible to buy a home when you're under 80% of that median, but other parts of the country, absolutely possible. And it's an awesome program. So USDA, what is the limitation there? The property has to be located in a USDA eligible area. And as less and less of the country is agricultural, less and less areas qualify. So the USDA puts a map on their website. So you should check your area. You can put in a zip code. You can put in a specific property, but you can put in a little bit wider to see that map and see which properties will be eligible in there. They also, you will see they have income limits that we'll talk about here in the next section. VA, the big and obvious limitation, really only one. You have to be an eligible veteran. Some National Guard and reservists qualify, but there's additional limitations on that. Most veterans know whether they're eligible for home mortgage benefits.
No, good stuff. So that kind of leads us into the next piece. We get a lot of people going, I believe I make too much money to do this type of program, or maybe I don't make enough money. Or I guess the better question is, how much money do I have to make in order to use this program, is kind of how it comes across. So do any of these have income restrictions, either making too much or making too little?
So FHA, no income limit. Conventional, no income limit on the standard program. If we get to Home Possible or Home Ready, as we said, you got to be 80% or less of the area median income, which there is a chart. You can just Google Fannie Mae AMI lookup.
We'll actually put it in the link below so that you guys can look it up.
Perfect. You can just plug in an address where you currently live. You can kind of see at a zip code level, but you want to look at that property and see if you're eligible. So for USDA, there are absolutely income limits there, and they vary by location and household size. So we'll pull that link also where you can look up where you're at and the size of your family and see if you would meet the income limit. So the property has to be eligible in a USDA defined a rural or agricultural area, and then you and your income and family size have to be eligible. VA, no limitations in terms of income.
Got it. So regardless of what program we're talking about here, we'll put the links below of what you need to know, either in the show notes if you're listening to it on audio, or if you're here on YouTube, you can check them out in the link below as well. But before we dive into the next piece, Josh, which is talking about credit scores, I want to take a minute and ask a favor. If you find any value in the content that we do here, guys, the one way you can support us is by liking the content, by subscribing to the channel. Not only does it push us out to more people like you, it helps us accomplish our goal of educating home buyers and educating people on loan programs exactly like this. So Josh, we've talked about some of the important pieces that people want to know. I think the next one is probably the more important piece for most people, at least in deciding which direction they're going to go if they're have all these options available, and that's credit score. So when we're talking credit score, what do we need to think about?
So first of all, I want to say in broad strokes, when we talk about a minimum does not mean you are guaranteed to be approved. A minimum means if you have this score, you might be approved, and below that, you cannot be approved. There's a lot of videos out there educating people saying, hey, FHA 580 minimum credit score. That is absolutely correct. At a 580, a 590, a 600, you are very unlikely to get an automated approval, which would mean you would have to have a manual underwrite, which is going to come with some pretty severe limitations. So FHA, 580 is your minimum. You can go all the way down to 500. Below 580 requires 10% down. So for that 3.5% down, you have to have at least a 580 credit score, although it doesn't guarantee approval. The conventional 97, the conventional Home Possible, Home Ready, they all require automated approval. but they fall under the general scope of Fannie Mae and Freddie Mac, which the guideline minimum is 620. Again, you get towards that lower bound, you are less and less likely to get an approval. And with the minimum down, you are going to be required to get the automated approval. There's no manual underwrite with that. So when we kick it over to USDA minimum is 640, so a little bit higher than the other programs. And they kind of are like FHA. Towards that lower bound, you may not get approval through their automated underwriting system, which is known as GUS. So 640 is your minimum, but you may have to go to a manual underwrite, which gets stricter on your qualifying guidelines.
Well, I actually did that video on USDA, Josh, and the lady from USDA, works at USDA, reached out to me directly and said, we actually don't have a minimum credit score. So while there are guidelines that say it, if it's below a certain threshold, it's going to have to be a manual underwrite. And in some cases, you could get approved with less than a 640.
Okay, so good news there. But remember that lower credit score, you're going to have a limitation on that manual underwrite of what that max DTI is. I believe their guidelines say it's about a 46, but we'll go through that. USDA for us here, based out of Southern California, is not something that comes up real often, but it is a great program for those that qualify. And then again, just to reiterate, VA, no minimum FICO, but the lower you get, the less likely you are to get an automated approval. And then you have to go to a manual underwrite, which limits your lender options and comes with generally overlays, restrictions, requirements that are going to make you qualify for less and at worse terms.
All right. So now let's kind of move into debt to income ratio. So this is how a lender determines how much home you can actually afford to purchase, right? So if you meet all the other qualifications, they're looking at how much debt you have versus how much income you make to determine how much home you can actually afford to purchase. Now, Josh is going to tell us the numbers here in a moment, but I want to make a point here. A lot of people think when I say debt, they're thinking all of the things that they pay out every single month. That's not what the lender's looking at. They're looking at things that show up on your credit report, things like car payments, credit cards, student loans, any sort of revolving installment debt, typically anything where you had to apply to get credit. That's the stuff that's going to show up on your credit report. If you went and got furniture from a furniture store, they said, hey, do you want the card? You say, absolutely. That's what we're talking about. We're not talking about what you spend on daycare or groceries or date nights or any of that other stuff. It's important for you to budget so that when you are having that conversation with Josh and Josh says, hey, this is how much home you can afford to purchase based off of, your income and your debt and all of that, I'm comfortable with that because I have a budget on this side. But Josh, I kind of went off on a tangent, but it's important for people to understand that. So when we're talking debt to income ratio, a lot of times this dictates which program someone uses.
Absolutely. And with the credit scores, it's sort of the opposite of FICO. When we're talking about your credit score, this is your minimum. So if you meet that minimum, it doesn't mean you're guaranteed to be approved. When we talk about maximums here, not every borrower is able to go to the full max. So starting with FHA does not have a published maximum if you get an automated approval. But in observed reality, every loan officer who's done a bunch of FHA loans knows you'll never get an approval above 46.99% housing to income ratio. So just the housing payment to your income, or above 56.99% of your total debts to income ratio. Now, if you have a lower credit score and it has to go to a manual underwrite, the max on the manual is a 40% over 50%. And that requires two compensating factors. We're not going to go down that rabbit hole of compensating factors today, but you actually have to have some good things in your favor that says, hey, I can afford and manage and will be able to make my payments at 50%, where with that automated approval, you could potentially go as high as 57% or just under 57% without the compensating factors. Now, all of the conventional loans, Fannie, Freddie, so the standard 97, the Home Possible, Home Ready, they will allow you to go up to 50%, but it is per the automated underwriting. So if you're at 49% and the automated underwriting may very well say yes, who's it likely to say yes to? Someone with an 800 credit score, someone who has $30,000 in the bank after closing. Good thing. So they're not technically called compensating factors, but the automated underwriting is looking at your overall picture. Now, if you have a 682 credit score and we're at a 49.9 total debt to income ratio, and we're using every nickel you have to close, likely going to bust you down probably to a 45. But again, it is absolutely up to the automated underwriting system. We already talked a little bit about USDA, GUS, their automated underwriting. They also have no published max for that in their guidelines for manual underwriting. If you get push down to manual underwriting. It's 32 over 44 if you have a 680 credit score. So with a 680 credit score, you could go as high as a 44%, but you're going to need those compensating factors again. VA is the most interesting of all because they legitimately have no maximum debt to income ratio. In the guidelines, it says that debt to income ratio is to be considered, but it is not to be the deciding factor. They rely heavily on a residual income calculation, and that takes into account some of the things that you said we don't count in debt to income ratio. What are your maintenance and utilities for your house? If you're buying a house, they're going to sort of come up with a pseudo number for you at 14 cents per square foot. They're going to ask you, how much is childcare for your kids? So they're trying to look with that residual income calculation and say, net income after all your withholdings, then less all of your expenses, including childcare and keeping up your home. Do you have enough money left to put food on the table, gas in your tank, and clothes on you and the kids? So no maximum, but they're definitely measuring and going to make sure that you are going to be a good risk, both for their reasons and yours to be able to afford that home.
No, that's good stuff. If you guys aren't paying attention, you need to be working with a professional when you're going through this process, right? Not everybody knows the guidelines like Josh and our team here. So if you're going through that process, you're looking to start the pre-approval process, maybe you're already in the process and speaking with someone else, want a comparison. If you want to work with Josh, our team here at BuyWise, do us a favor. Just, click the referral link in the description below. You can speak with Josh or one of our referral partners and go through that process at no charge. So, Josh, interest rates are an important piece because they affect everything else. They affect affordability. They affect your monthly payment. More importantly, how much you can afford to purchase, because a lot of that, that's one major piece of the puzzle. So rates, how do rates compare when we're breaking down these different programs?
Let's look at them relative to each other and use FHA as the baseline. Today is March 13th. So on March 13th, I can tell you the interest rate. They could be higher or lower this afternoon, and a week from now, they could be significantly higher or lower. So don't focus here on the rate. Let's look at the comparison between these. As of today, I looked it up, $500,000 loan, maybe high for your area, maybe low for your area, but a 680 credit score, kind of middle of the road, good but not great. That borrower on an FHA with 0 points today is going to get about 6.125%. On a USDA, we're going to be looking about 6.125% for that 680 borrower with a 0 point loan. VA is going to be slightly worse. Some lenders are going to be identical. Most of them are going to be about 1/8% worse. So instead of 6.125, you're looking at 6.25. So for all intents and purposes, those all are very similar, and they're going to be similar for most borrowers. If you drop down to a 640 credit score, maybe you're paying 1/8 more in rate. If you go to a high balance loan on an FHA or a VA, you're in an area where you can go above the conforming limits and you're getting $1 million loan, it's going to be maybe 1/8% more. Not going to vary a whole lot from that. But when we switch over to the conventional, either the standard 3% down or Home Possible and Home Ready, they can vary a good bit. So let's start with that standard 3% down where you have to be a first-time home buyer. I wanted to throw two numbers in there. If you are that 680 borrower, that rate jumps all the way up to 7.375 today with 0 points. You could get it down to about 6.875 with 1 point. But again, if you're only putting 3% down, you probably don't have another percent around to buy that rate down. So we're generally looking at 0 point options. So how does that compare if the score just went up to 740? It went from the low end of good to the high end of good. That takes that rate all the way down to 7%. So you're either over 1% worse than FHA, USDA, VA, or 3/4, 3/8, or 7/8 worse than that. So any way you cut it, the conventional loans are going to have a higher interest rate. And now I'm going to throw out a giant but to you. The reason why those rates are higher are many, but the way Fannie Mae and Freddie Mac do it is there's loan level price adjustments. So the lower your credit score, the higher your loan to value, the more these add up. So that's why that borrower with a 680 credit score pays much worse than a 740. Now, in the last couple of years, we've had some significant changes to how they do this. Fannie and Freddie will cap loan level price adjustments if you're at or below 100% of the area median. So to be eligible for Home Possible and Home Ready, you got to be at or below 80%. Well, if you make more, but not a ton more, and you're still under 100%, then we have caps on those loan level price adjustments. And almost any borrower, 660 credit score, 680 credit score, 690 credit score is going to be at that lower end, just like the 740 credit score, somewhere around 7% today. Still, any way you cut it, at least 0.75% higher than FHA. Now, what program do we really start seeing where we can go, that makes a lot of sense to look at versus an FHA? It's for those folks that are home possible and home eligible ready. If they're at or below 80% of the area median income, that 0 point rate today drops all the way down to about 6.5%. Because of those loan level price adjustment caps, because of the improved in pricing incentives, you're looking at a much lower interest rate. So it's going to be 1/4 to 3/8 higher than an FHA. So the conventional loans are all going to be higher. Doesn't mean we shouldn't do them. It just means be aware that the interest rate is slightly higher on conventional loans than any of these other options.
And with that said, Josh, that we're going to get into some other things like, loan size, property type, refinancing requirements, that sort of thing. But mortgage insurance plays a big part because there's a way, if you will, to kind of get a blended rate, so to speak, between what your interest rate is plus whatever you're paying in mortgage insurance. To get an idea of maybe which loan program is going to be better, because an interest rate on, say, FHA might be better than conventional, but the mortgage insurance might be less or more on another, and effective rate, if you will, could vary. So let's talk about here. Let's take a minute here and talk about mortgage insurance, because it is a very important piece, especially when it comes to conventional loans. And I guess more so too when FHA, when you're only putting 3.5% down, there's some things that people need to understand.
Let's start with the easy one. VA does not have monthly mortgage insurance, so that's zero. If you look at FHA, it's 0.55% annually, but paid on a monthly basis. So it's essentially adding 0.55% to your interest rate. USDA works very similarly in that it's 0.35% added to your interest rate. Now let's keep on the tack of those three programs because they also all have an upfront component. So VA doesn't like calling it mortgage insurance. They just simply call it a funding fee. But the funding fee goes to the VA and is put into a fund to offset the losses on any defaults that veterans experience. So it's in essence mortgage insurance, whether they like to call it that or not. And that can vary anywhere from about 2.1% up to almost 4%. What's it going to vary based off of? Have you used your VA benefit before? Are you putting a down payment and it's 0 is going to pay the highest rate? 5% to 9.9 is going to pay a lower rate, and 10% or more down is going to pay an even lower rate. But for the purpose of this, you're probably looking at a 0 down. You're looking at that 2.1% VA funding fee from that perspective. Now, if we switch over to FHA is 1.75%. So the important thing to remember about the VA funding fee and the FHA upfront mortgage insurance premium, they're financed into the loan amount. You can pay them out of pocket. Hardly anyone, especially first-time buyers who are doing minimum down, have extra money and choose to pay it out of pocket. So on the VA, you put 0 down, you add the funding fee, you actually owe more than you paid for the home. With FHA, you put 3.5% down, and then you add the 1.75 back on there. So you have a little bit less equity than the down payment you made. Forgot to mention their USDA. USDA is almost identical in kind of how it works in terms of this, like FHA, but 0.35 on the monthly, 1% on the upfront. So let's say you were USDA eligible, the property is USDA eligible, and you were also approved for an FHA. We already went over the rates are similar, but the mortgage insurance is cheaper. You don't have to put a down payment. Probably tells you USDA is the good option, but hopefully your loan officer is putting both of those numbers together and putting them in front of you to review. So where it gets harder, Jeb, is when we start talking about conventional loans, because conventional mortgage insurance varies on a number of factors. We already talked about credit score. The lower your credit score, the higher your mortgage insurance. If you have 2 borrowers on the file, it's going to be lower mortgage insurance because we don't have a single point of failure. If Jeb's the only borrower on the loan, he gets hit by a bus, lender's probably not getting paid back.
That's not cool.
If it's Jeb and a partner, at least we have one other person who's still able to pay it. And not even just hit by a bus. You lose your job. They like having multiple people on there.
Still not cool.
The less money that you put down, the more you're going to pay. So we're talking 3% down. You're going to be at the higher end of that. So let's look at a couple of numbers from that perspective. That conventional 97, if you only have that 680 credit score, We already talked, you're at a 7.375 interest rate, over 1% higher than the FHA. That mortgage insurance is looking at 0.94% on a monthly basis. So instead of 6.125 plus 0.55 on the FHA loan, which roughly puts you in the range of about 6.75, you're looking at 7.75 or 7.375 plus another percent. You're at almost 8.375. There's like no comparison for a 680 borrower who's making more than 80% of the area median income. They would absolutely want to use FHA, but again, your loan officer should show you this in a side-by-side comparison. Now, let's say again, we go up to 740. How does it vary? 740, 2 borrowers, you're looking at 0.49. So it's actually cheaper than the FHA. So you had that lower rate of 7%. You have the MI at 0.49%. So now we're getting much closer where you would want to look at that comparison. And what might tip the scales towards your conventional for you, even though the payment is going to be a little bit higher, is you don't have that upfront mortgage insurance premium. So you're going to have more equity in the home on the way in. So hopefully you're seeing here, there's not a right answer. There's trade-offs with all of these programs. First of all, am I actually eligible for them? And of the ones I am eligible for, what are the trade-offs and what am I most comfortable with? Your loan officer, your realtor, they should not be making this decision for you. They should be arming you with the facts so that you can make those decisions. Now, Jeb, the last one in terms of mortgage insurance, Home Ready and Home Possible, we already talked about it's a much lower interest rate because those loan level price adjustment caps. They have lower mortgage insurance because the coverage requirement is less. You're only required to have 25% mortgage insurance coverage. So those numbers drop down to 0.79% and 0.45%. So for the higher credit score, not a whole lot better, but for those lower credit scores, it starts getting a lot more attractive. So if you have a 680 credit score, if you're not Home Ready eligible, you're probably not even going to consider a conventional loan. But if you are Home Ready eligible, it is an attractive option relative to FHA.
All right. So good stuff, Josh. There's a couple things that I didn't hear you mention that I just want to make sure listeners are understanding. With FHA, with USDA, with VA, regardless of your credit score, the mortgage insurance is the same, guys. So you're going to, if you have a 780, you have a 650, the mortgage insurance doesn't vary. The upfront's the same. The monthly mortgage insurance is the same. The variation here, I don't believe you said it, on VA. Occasionally, you can avoid that upfront mortgage insurance premium, the funding fee rather, if you're disabled. Or a percentage of disabled. So maybe talk on that in just a moment.
10% or more permanent and total disability will make you exempt. So in simple terms, if a veteran has a VA service-related disability, they know. But if you're receiving a monthly payment on a monthly basis on your certificate of eligibility, it will confirm for us that amount and it will state that you are exempt from that funding fee. Also, Purple Heart recipients are also exempt from funding fees. So much more rare than disability rating. But yes, for those veterans who are VA eligible and are exempt from the funding fee, I would say almost 100 out of 100 times the VA loan is going to be the right answer for you.
All right, good stuff. And the last thing I want to make sure we cover is that mortgage insurance is usually required on loans when you put less than 20% down. When you're doing an FHA loan, you're doing a USDA loan, regardless of how much you put down, you're going to have mortgage insurance on that loan. Now with FHA, it falls off after the 11th year. USDA, I'm not sure if it ever falls off. Conventional.
With FHA, it's permanent, Jeb, unless you put 10% or more down.
Well,
anything less than 10%, it will stay on there for the life of the loan.
Correct.
I also am not 100% sure about USDA just because we don't do a whole heck of a lot of them here. But the bigger portion of that, another sort of check in the column for conventional loans is once you achieve 20% equity in the home, either through appreciation or principal pay down, and you've made your payments on time. That's important to remember. If you're missing payments, they can require you to keep that mortgage insurance and protect the lender, but it can be removed, whereas the monthly mortgage insurance on the FHA is not going to be able to.
And here's the deal, guys. We've done an entire episode on mortgage insurance where we've gone into detail about what it is. If you're looking for more information on that, we'll actually link to it here in this video so you can get that. Now, Josh, property type. Typically, property type doesn't really matter, right? Any type of loan you can do on any type of property outside of manufactured and mobile and that sort of thing. But let's kind of go over the guidelines real quick just to give a recap.
So this is a pretty simple category. All of these are going to let you do a single family residence or a condo. All of them also have allowances for buying a manufactured home. There's going to be some restrictions and requirements. So not every manufactured home, but in general, a manufactured home can be purchased. So what other types of properties might you be interested in buying? Primarily units, 2 to 4 units. So FHA, again, there are some limitations. 2 units is treated very similarly to a single family. 3 and 4, we get some additional limitations on it, but you can do 3.5% down on 1 to 4 units, no problem. Now, when we switch over to the conventional 97, you cannot do units. But if you go to Home Possible and Home Ready, they will allow units, but you're going to have to do 5% down. USDA doesn't allow units, and VA does allow 2 to 4 units, but you're going to have, again, some restrictions and requirements in terms of how you can use that income from the other units to qualify.
All right, good stuff. Kind of moving us along here. With FHA VA, just so you know, they allow you to do condos, but there is some eligibility requirements for condos when it comes to FHA and VA. That the condos have to be approved by FHA and VA. So you do want to touch on that real quick?
Absolutely. That's an excellent point, Jeb, because sometimes for some borrowers, they may not be able to go with the ideal loan program. FHA, up until about 2009, 2010, what would happen is a complex would apply and supply all their documentation for the FHA to review, and they would get approved and they would go on the list. FHA never went back and confirmed that they're still being financially managed, that they're still doing maintenance on the property, that this is still a good complex for an FHA buyer to make an investment in. So they realized, hey, this is dumb. They had serious problems above and beyond just what the normal market had in 2008, 2009. So they said, we are ripping everyone's approval. So if you want to be FHA approved, you have to come back and reapply, and you have to reapply on a regular basis. I don't remember, it's every 2 or 3 years. So many complexes chose not to. So we went from a situation where 80 to 90% of condos were FHA approved. Now we're probably somewhere 30 to 50%, depending on your market. So it's important to know some lenders will do a spot approval. Some lenders have a process where they can get a complex rapidly approved in 3 to 4 weeks if you have a seller who will cooperate with that. But you do generally need that complex to be approved ahead of time. VA has a very similar process, also can get approved very quickly. But if you are wanting to use one of those loans and you're not on the list, they don't do it the way conventional does. Conventional, as part of the underwriting process, we provide an HOA certification and certain HOA docs, and the underwriter goes through and goes, yes, this meets the requirements for Fannie Mae and Freddie Mac. So sometimes if your complex isn't FHA or VA approved, you can get pushed to a conventional loan just because we have more flexibility there.
All right, good stuff. Last thing, Josh, let's talk about refinancing. Big question. People want to know, how soon can I refinance after getting into a loan? What are, I guess, kind of the requirements? There's 2 loan programs that are significantly easier to refinance than say conventional. So why don't we just touch on that real quick?
All loans you can refinance. In general, you can refinance immediately. And I say in general because if we're going to use one of those special refinance programs where you're not qualifying income-wise, where you're not getting an appraisal, they all have waiting periods. They don't want someone, hey, rates drop in 60 days and come back and redo the loan. So for the most part,
what's a special loan program? What are we talking about?
Absolutely. So FHA offers their streamline refinance. VA offers their interest rate reduction loan. And there's also a USDA streamline. USDA is a little dicier on the guidelines, but for the most part, all 3 of these, you're going to get the benefit of not having to document your income as long as you've made your payments on time. So the lender's looking at it saying, this is a rate and term refinance, meaning we're not taking cash out. We're only lowering your interest rate. So you've made your payments up till now. We're putting you in a better situation. We're on the hook for guaranteeing this loan to the investor. So if we're putting you in a better position, we will guarantee this again. So you don't need an appraisal. So if the property goes up or down in value, doesn't matter. Income, if you don't have a job, VA, FHA don't require us to document that you have employment if you're making the payment on time. Some lenders do have investor overlays where they will require you to document that. So USD is very similar. So sort of a downside in this regard is if we're looking at conventional loans, that's always going to be a full qualifying refinance. You're going to still have to income and debt to income qualify, and that property is still going to have to appraise and meet the loan to value requirements.
You know, the government does a lot of silly things, Josh, but when it comes to FHA, VA, USDA, all government type programs, it makes sense that if you've qualified initially and we're helping you out and lowering your payment, why don't we allow you to do this with limited documentation? If you're in a better position, I don't completely understand why conventional hasn't caught on to that to some degree, just because you do have to requalify and in some cases, people won't qualify again just because of change in circumstances, even though they're still making their payments at a higher rate.
Well, the big changes after 2008 were the ability to repay guidelines. So what is the number one predictor of ability to repay? It is making the same or higher payment. So if someone has owned a home for 4 years, 2 years, 18 months, and they've made that payment on time, and we're dropping the payment $100, $200, $300 a month, it follows that they have demonstrated the ability to repay. I would love to see Fannie Mae and Freddie Mac come up with something similar there. Jeb, the one thing that we didn't talk about here, and for most people throughout the country, this isn't going to make an ounce of difference, but maximum loan size, and we deal with this here in Southern California, is that we can go on FHA up to the high balance loan limits, which is now almost $1,150,000. So FHA, the loan limit is going to vary by county, and it can be lower than the Fannie Mae, Freddie Mac limits. So some people, if you're in a low-cost county and you're buying a mid-priced home, may push you towards a Fannie Mae loan. Fannie Mae, Freddie Mac loans are going to follow those conforming guidelines. So 766, 550. So for most purposes, when we're talking about 3% down, folks here, if you're not in a high-cost area, that's going to be more than enough to buy a home with 3% down. So if you are in a high-cost area like Los Angeles, like Orange County here, you can go to the high balance limits, but you can't do 3% down. You then will get pushed to having to do 5% down if you go to 800, 900, $1 million. VA is probably the most important one here, is that there is legitimately no limit on the loan amount. As of 2020, they passed the Blue Water Naval Act, and to finance and fund some other things the VA wanted to do, they said, hey, we'll get more in funding fee if we eliminate this loan limit. So in practical terms, there are limits that investors will make on it. Most of them are going to cap a loan with zero down at 1.5 to 2.5 million. But we've got a couple of investors that will loan you $4 million with zero down on a VA loan. So important to note. Also important to note, USDA does not put a loan limit, but in practical terms, there's an interest rate on any given day, and they have those income limits. So there is a practical limit to what you can borrow based off of their debt to income guidelines, your income under those limits, and current interest rates.
No, good stuff. I mean, I feel like that was a really good breakdown of all the loan programs, comparison. Understand there's a lot of mortgage professionals out there in the business, a lot of loan officers. I can assure you that 90% of them don't know the guidelines like Josh went over. So if you're going through the process, just make sure you're working with a professional. If you want to work with Josh in one of the states that we're approved, there's a link in the description below. If we don't personally serve that state, we can put you with someone on our team that can guide you through that process and take great care of you, just like Josh would if he were doing your loan. So it's important, again, to make sure you're working with that professional just for comparison, right? For nothing else, just compare numbers and the experience and the knowledge versus whoever you're currently chatting with. So Josh, if someone were looking right now to, I guess to start the process, what does it look like when they come to you and you just gave them a breakdown of 4 different programs?
The first and most important step is the initial discovery call. And I always start by, say, you call in, Jeb. I say, Jeb, what questions do you have for me? Because the funny part is, once you start asking me questions, you're going to fill in the gaps there. And I'm going to get a lot of the information that I would have to ask you questions to gather. Gives me an idea of what you're thinking. And what I will say, I said earlier, never let your lender or your realtor say, hey, you need to go this route, or this is the right option for you. They should present all those options, present the pros and cons. And if you ask them, hey, which would you do? It is absolutely appropriate for them to give you an opinion. But the job of the financial professional is to let you know what all your options are and help you come up with a framework for making that decision. So the most important thing is, after we have that discovery call, I know what your current situation is. I know what your hopes, your dreams, your goals, objectives are, what you want to buy. Now we start overlaying that onto which of these loan programs help you meet those objectives. What do they look like in terms of maximum qualification, how much your monthly payment is going to be, and how much cash you need to have, and then do you have that much money? Once we go through that, it is pretty rare that someone hasn't led themselves to that is the right conclusion. That is the loan for me and my family, and allows us to meet our goals with the lowest payment, lowest cash out of pocket, and puts us in the best position moving forward.
All right, good stuff, guys. If you found any value today, if you learned anything at all, do us a favor, hit that thumbs up, subscribe to the channel if you haven't done so already. But until next time, we appreciate you being here. Adios.
Amigos.